So welcome back to our extended classroom in managerial accounting, the extended classroom being my office at home. And this is my real office background. A lot of people have these virtual backgrounds. This is really my office here. And I'm not really in the streets of Paris. That's just a picture of the Eiffel Tower as taken in Paris, I believe, before the Germans marched in before World War II. Anyway, the purpose of this little video is to review the multiple choice portion of the exam. I will also do a similar little video on the take-home part, but I'll post that tomorrow so you have an opportunity to focus your thinking. So what I would do before you go any further, if you don't have in front of you your exam that I handed back yesterday, please get it out and then come back and watch the video. So I'm going to go question by question. So again, in terms of your grading, the multiple choice portion was worth 40 points. So I took the number you got correct. I divided by 40. I multiplied by 40, and that would have given you a number on the right-hand side, which would have given you the number of points for the multiple choice. And then each of the six problems was worth 10 points. So you'll see the amount of points you scored on each question. When taking multiple choice, a couple of things. One, oftentimes with multiple choice, you're posed with some answers that are some choices that are partially correct. So you always have to ask yourself, what is the best response? So all the responses will look good. So you're looking for the best response. Or in some cases, all the responses are so good that the answer is all of the above. And in some cases, all of the choices are so pitifully poor that the answer is none of the above. So get used to that discipline in multiple choice. Ask yourself, if there are several choices and they look good, which one looks the best? If they all look equally good, then it's all of the above. And if none of them are any good, then it's none of the above. So without further ado, let's get to the questions. And I'll go through them quickly. So you'll get the right answer. And if you disagree with me on what the right answer is, go back and look in your text first. And then when you see me in class, show me the documentation that supports why you think your answer is better than my answer. Okay, Airco is tempted. She sounds like something out of the Bible here. Is tempted to consider support department costs to be facility level costs that do not need to be applied. Which of the following explains what is misguided about this approach? The thing that is most misguided about that approach is product costs may be accurate because support departments may be used more heavily by some products than others. So the correct answer there is C as in cat. 2, joint costs are inseparable. This is the story of, it was originally Elmer, but out of respect for our own Elmer, I changed it to Clarence or something else, the story of the pig in New Hampshire. The costs spread before, the costs incurred before split off those costs are inseparable. So when we raised that pig in New Hampshire, before he came back dressed as ham and sausage and all sorts of other stuff and bacon, all the costs necessary to get him to the point where he was processed, those were the costs that were inseparable costs before split off. So joint costs are inseparable before split off. So the answer there is A. 3, which of the following are the 4 common methods for allocating joint costs? So the 4 common allocations are market value at split off, physical units, weighted average, and net realizable value. So the 4 choices are C. So that's the best answer. There's no such thing as the joint cost method. So that's one is, if you see something with joint cost method, those are all what we call red herrings, because there is no such thing as joint cost method. There are several different methods to allocate joint costs, and they are what you see there in C. Number 4, there was a little subtlety here. Under the net realizable value of allocating costs, which of the following equations relates to compute value of products not processed beyond split off? So at the point of split off, if you have products that are processed further, you take their net realizable value and then you subtract out any additional processing costs. But you don't have that for those goods that are not processed beyond split off. So for the one to get the value of the products not processed beyond split off, it's selling price at split off times the quantity. So the answer there is A. Number 4, which of the following is a drawback in using a single plant-wide rate? Well, a single plant-wide rate is unlikely. A single driver is unlikely that is the driver selected is appropriate for every type of method. So if you have several different departments for support departments or overhead costs, several different costs, there's likely some of them are best allocated on the basis of machine hours. Some of them are likely allocated on the matter of head count. Some of them on labor hours and so forth. So the best answer there, why you wouldn't want to use a single overhead rate, is that there's a single driver is unlikely because the costs are often react in behavior to different drivers. So the answer there is B. 6, which of the following explains why it's difficult to apply support department costs such as janitorial costs to products? Well, the best answer there is that it may be difficult to find appropriate cost drivers. So when you look for a cost driver, you're looking for the thing that determines what the support cost is. So in some cases, yes, it is related to the square footage. Some cases it's employees. Some cases it's other things. But sometimes it's damn near impossible to come up with an appropriate driver. So the answer there is C. 7, Woodbridge manufactures single grade wax lined paper takeout containers. So we make takeout containers for the food industry, and they want to know which of the following is most likely support department. So deli container, sandwich container, salad container, those are all likely departments in the manufacturing. Those are production departments. So the one that's likely to be a support department would be B, as in boy, janitorial. Which of the following statements is true about the sequential method? Well, sequential method captures some, but not all interdepartmental costs by allocating support departments, other support departments, and production departments in a series of steps. So that is a description. B is actually a description of the sequential method. We know it's better than the direct or step down, or whether it's better than the direct method. We know it's not quite as good as the very complex method that we didn't get into. It's in the appendix. So B is the correct one. That's sequential method. That actually describes the sequential questions. 9. Those first 8 questions, by the way, would remember these go in sequence, and I took 4 from each chapter. So those first 8 were from chapter 5. Next 8 have to do with chapter 5, which is all cost volume profit analysis. Most operating decisions of management focus on a narrow range of activity, and that narrow range of activity is called relevant range. That's the range within which the fixed costs are truly fixed and the variable costs are truly variable. So the answer is A. Number 10, the point where profit line intersects the horizontal line on the profit volume chart. So if you got this wrong, go back and look up a picture of the profit value chart, and you'll see the point where the profit line intersects the horizontal line. That is the break-even point. Yeah, the question was there on the profit value chart. Profit volume chart, rather. 11. So they give us information and they ask us the amount of sales required to achieve an operating profit of. So you want to get the operating profit. So look down below here. The operating profit would be the fixed cost plus the targeted profit divided by the contribution margin, which is sales minus variable costs. So it's 14,167. Wherever you have computations, do the computation first and then go looking for it amongst your choices. 12, which of the following would be classified as a fixed cost for a t-shirt manufacturer? Or which of the following would be classified as a fixed cost? Well, none of these are fixed costs. So electricity, they give you the rate per hour. Hourly wages, cotton and polyester cloth, those are all variable costs. So correct answer there is D. None of those are fixed costs. 13, in a cost volume profit chart, total cost line doesn't begin at 0. The slope of the line is not dependent on the cost per unit. Total cost line normally ends at the highest sales value, not necessarily true. The total cost line begins at fixed cost and variable cost on the vertical axis. So the correct answer there is C. And if you don't believe me, go look at a cost volume profit chart. Okay. 14. Which of the following conditions would cause break-even to increase? So break-even increases if either the fixed costs go up, the sales price goes down, the variable cost increase, increase. So the one that causes the the break-even point to increase is you get an increase in the variable cost, which means when you divide the fixed cost by the sales price minus the variable cost, if the variable cost goes up, then your contribution goes down, which means you're going to increase your break-even point. 15, as production increases, the fixed cost per unit remains the same. Oh, I'm sorry, as production increases, fixed cost remains the same, but the fixed cost per unit actually goes down. This is divided amongst more units. So the answer there is B. 16, which of the following is an example of a cost that stays the same as the total number of units or products produced changes? Well, that would be any fixed cost. And the only one there that is an example of a fixed cost is depreciation on factory machinery. And it's straight line depreciation, which means the depreciation is not dependent upon how much you use the machinery. If you use units of production depreciation, straight line depreciation is going to be the same regardless of how many units you manufacture. So a cost that stays the same regardless of the numbers that produced, the answer there is C. So 9 through 16 were taken from chapter 6 rather. Now we're into chapter 7, which had to do with variable costing, which the following is a reason for easy identification and control of variable costs under the variable costing method. Well, all of those are true. All of those things are true. So all of them, it says which of the following is easy identification and control of variable costs. So these are all true. So variable and fixed costs can be reported separately. Variable costs can be controlled by operating management. Fixed costs are normally the responsibility of higher management, not the operating management. So all of those are good choices, good reasons to use variable costing. So the answer there is D. 18, the contribution margin is computed as contribution margin ratio. Contribution margin ratio is computed as contribution margin divided by sales. So the answer there is B as in boy. 19, the amount of income under absorption costing will equal the amount of income under variable costing when the number of units manufactured equal the number of units sold. Remember that little chart I kept putting up on the board there? When you compared the number of units manufactured and the number of units sold. So when they're the same, you're going to get the same answer. So the answer there is B. Number 20, under variable costing, which of the following costs would be included in finished goods inventory? Wages, steel, electricity, all of the variable costs. And this is where a number of you lost points when you did the detailed problem on variable costing. Your ending inventory, you're going to have ending inventory under variable costing, but it's only going to include the variable costs of manufacturing, so which includes wages, steel, and electricity in this case. So the answer is D. Amount of income under absorption costing will be more than under variable costing when the number of units manufactured is larger than the units sold. And the reason for that is you've got ending inventory is going to include fixed cost, whereas under variable costing, the fixed cost is always written off during the period. So the answer there, and again, that's why I kept putting that chart up on the board for you. When you should be able to look at the volume produced and the volume sold, and then you should, on the basis of that, you should be able to say which will give you higher net income, absorption or variable. So if you produce more than you actually sell, then the answer, you're going to get higher profit under absorption costing. So the answer there is A. 22, on the variable costing income statement, the figure representing the difference between manufacturing margin and contribution margin, well, manufacturing margin minus variable selling and administrative expenses will give you your contribution margin. So manufacturing margin is simply sales minus the variable cost of manufacturing. That gives you variable gross profit, and then from that you've got to actually subtract out the selling and administrative expenses to get the contribution margin. 23, which of the following would be an appropriate activity based for which of the following would be inappropriate for a cost analysis in a service firm? Remember, service firm, you have no inventory, So that could be, you could be mowing lawns, you could be providing some customer to service, you could be providing haircuts. So the one that would be an inappropriate activity base for a service room would be inventory. 24, which of the following is required by generally accepted accounting principles? Well, when it comes to the inventory, the only one acceptable for GAAP is absorption cost. So under generally accepted accounting principle, your cost of manufacturing and your cost of ending inventory has to include the fixed overhead. All right. So those that was 17 through 24 were from chapter 7. And now we're into chapter 8, which has to do with budgeting. And the first one asks you the number of units that must be produced in September. To get the number of units produced in September, you take the sales for September plus the ending inventory that you want to have at September minus the beginning inventory that you had at the beginning of September. So you use these numbers up above and you find out that sales was 20,000 for September. The ending inventory for September is 20% times the number of units that would be that you want to have in ending inventory, and that's 40,000 for the next month, which would be October, minus the beginning inventory, which would be 20% of the sales that you had in September. So it's sales plus ending inventory minus beginning inventory. Answer is 24,000. Answer is A. Okay, next one. Total selling expenses for the month of March. Selling expenses for the month of March are 5% of sales, which is 50,000. Sales manager's salary of 85,000. Advertising of 65,000. Shipping expenses are 1% of sales. 1% of sales is 10,000. Plus selling expenses, and again 1%, and 1% of sales is another 10,000. So your total selling expenses there are 217,000. 27. So they give us information. In order to answer this question, you have to know what the beginning cash is in January, which is 290,000. And you want to keep a minimum cash requirement of 340,000. So the question is the amount of deficiency or excess after considering minimum cash balance for January is. Okay, so the beginning cash for January is 290,000. You got 1,061,200 worth of receipts. You got 984,500 worth of payments. So you're going to have a cash balance at the end of January of 366.6. And the minimum cash balance the company wants to maintain is 340,000. So 366 minus 340. So they're going to have excess cash over and above the amount required of 26,700. So answer there A. 28. Which of the following is the integrated set of operating and financial budgets for a period of time? I think that was Edward's definition from the back of the room. Edward, I can still hear your voice. That's the master budget. So the master budget is an integrated set of operating and financial budgets for a period of time. 29, a disadvantage of static budget. Static budget is you just have one budget and you don't adjust it for activity levels. So it does not allow for possible changes in activity levels. So that's a big disadvantage of static budgets. We did an example of that when we introduced budgeting. Which of the following estimates the number of units to be manufactured to meet budgeted and desired inventory levels? That's the definition of a production budget, C. Which of the following should be ignored when preparing a cash budget? Well, the one that can be ignored when preparing a cash budget is depreciation, because depreciation is a non-cash expense. Remember back from Financial Accounting 1, when you recorded depreciation expense at the end of the period, you debited depreciation expense, you credited accumulated depreciation. So depreciation expense is a non-cash expense. So the answer there is B. And the primary budget in a non-manufacturing business is staffing. That's the primary budget in a non-manufacturing business or a service business. Okay, so I hope you found that review useful. What I'll do at the beginning of the next class is I will again remind you of how useful the diagnostic questions are preparing for the multiple choice. As I said when I gave out the exams last night, people tended to do far better on the take-home part than the multiple choice part. So you really have to hone your knowledge of the multiple choice, which tends to be more conceptual and really tests your deep understanding. Whereas the other thing, you can learn something through repetition. So the take-home problems are useful, but sometimes it's possible just to follow the example and not really understand what you're doing, which is why we got to do a combination of both. Okay. And I will do a separate little video, which I'll post on Saturday on the take-home part of the exam. Be well, folks. Have a great weekend. See you soon.